The topic is adjusting the accounts, which sounds a little deja vu-ish. The last time we were together on a Monday, we started talking about adjusting the accounts. And for 2 weeks now, you've been doing homework problems that were in some way, shape, or form adjusting the accounts. It's an important process that we want to get better at. One of the things that we need to understand is that there are, broadly speaking, two ways in which we could account. They're called the cash basis of accounting and the accrual basis of accounting. Now, about 98% of this book is accrual basis of accounting. But it is also possible to use the cash basis of accounting in appropriate circumstances. And I'd like to contrast them real quickly with you and for you in the next minute or two. It's all about the way we handle revenue and expense, about expense and revenue recognition. Under the cash basis of accounting, we recognize cash when we literally receive it in cash. Under the cash basis of accounting, we report expenses when we pay them. If you've learned anything in accounting up to this point, I hope you understand that that's not the way we've been reporting things. We've been waiting until we earn the revenue and until we incur the expenses to report them as revenue and expense. It was more about when we did the work than it was getting cash. It was more about this event happening, incurring it, than it was paying the cash. We recognize under the accrual basis of accounting expenses when they're earned. Expenses when they're incurred, and revenue when it's earned. And those are important concepts for us to understand as we prepare and report our financial results to other people. When we prepare the financial statements, we need to take that into account. This abbreviation stands for Generally Accepted Accounting Principles. In other words, following the rules that are applicable in the U.S. How would we best report this? And our textbook is well aware of that, and that's the reason it's so skewed toward the accrual basis of accounting. That's what we're learning the most. Now, as we approach the preparation of the financial statements, we're concerned with some accounts are accurate and up to date, and some of them aren't. We need to be able to update those that aren't. That's one of our objectives. We want to prepare the best, most accurate, reliable financial statements we can. And the adjustment process is one step in accomplishing that. In Chapter 1, I promised you that every business transaction would have two effects on the accounting equation, and they would balance. In Chapter 2, we discovered that every entry could be recorded with a debit and a credit minimum, and they would balance. And I'm here today to share a Chapter 3 promise with you. Every adjusting entry we make will have one balance sheet and one income statement effect. You can count on it. Now, that's good up front, and it's good looking back. Up front, when you're trying to decide what adjusting entries to make, it's nice to know you're looking for half an entry that affects the balance sheet and half an entry that affects the income statement. You watch for it. Look back at the adjusting entries you've made already in the previous assignments. Look at the ones you're about to make in the assignments this week. It should be obvious to you. But the other thing, the real reason I'm bringing it up today, is when we make an adjusting entry, both financial statements are better. Or consider it the other way. When we don't make the appropriate adjusting entry, both financial statements are worse. Did you get it? When we make the appropriate adjusting entries, both financial statements are better because of our actions. One of the words I've been reluctant to say that is the reason for a lot of what we do is a concept called the matching concept. The matching concept is the shortest summary we could give for what we're trying to accomplish on an income statement. We're trying to match. I think there are three important components to this concept. We're trying to get all the revenue that belongs in this time period, offset by all the expenses that we incur in this particular time period. It's revenue, expense, and time. We want to prepare the best income statement we can. When we use appropriate techniques to recognize revenue when we earn it and get all of that revenue in this time period, we feel good about what we've accomplished. When we analyze the expenses and attempt to offset that revenue with all the expenses we've incurred, matching them against revenue, then the result, net income or net loss, is the best we can come up with through the techniques that we had to work with. Matching. It seems to me that all the adjusting entries fall into two broad categories. They are either accruals or deferrals. And I kind of tempted you, tantalized you a bit, tried to provide the way until today, 2 weeks ago when we were together the Monday before Labor Day. We've talked some about how there's a pattern among the adjusting entries that we make. As part of what we're doing today is just putting labels on things that we've already done. Accruals and deferrals. One of the things I'd like for you to know about them is how to recognize them on site. I have two what I consider to be gifts for you today. Spence, may I borrow yours just for a second? One of them is the decision tree you've passed by. I'll have more to say about that in a second. The other is this timeline on the handout about the distinction between accruals and deferrals. I think that accruals can be differentiated from deferrals by when cash changes hands. It seems to me that accruals are events that are happening that are followed by the exchange of cash. Accruals lead up to the exchange of cash. Deferrals start with cash, and we set about seeing that event take place. Deferrals start with cash and then transpire. Now, I contend that you know 50% or more of what I'm explaining today. Sure, I'm going to add some new things. But what I'd like to do is see some things that you know already and build your confidence and have you cling to those as well. Just learn others that are like them. This idea that we spend money first and then use it up is one that we experienced with buying supplies. The very first day of class we were together. We were a tutor. We went down to Office Depot. We bought supplies and came back to the dorm room. That we now know is a deferral. The only thing that's new about that is the label that we just placed on it. This is the first time I've used the word deferral in front of you. We paid insurance premiums in advance and then used them up. We paid the rent and then used the building that we were entitled to use. Those were all examples of deferrals. The last Monday we were together, we talked about accruals being things that we got the good out of, like employee salaries and wages. Employees work for us, and then we pay them after the event. Or we get a bill for the utilities, and then we pay it later. Or we owe money on a note, and every day that passes we're incurring interest on that note. But we pay the interest later. Those are all examples of accruals. Accruals come before the exchange of cash. Deferrals come after it. And because deferrals start with the cash exchanging hands, then we have to write something down. Deferrals have something written on the books already. Accruals don't. Accruals are happening, and there's not always a reminder for us to write it down. When the end of the year falls during this time period, or when the end of the year falls between this time period, when we're about to prepare financial statements, it's even more important that we consider the impact of accruals and deferrals on the financial statements themselves. Thus, the need to make adjusting entries. From this definition, we get the decision tree that's on the first page. Now, if you want to flip back and forth to it, you may. If you want to just kind of snap it off the staple and have it out on the desktop so that you can see it throughout this, that might be a good idea too. I'd like for you to see how it unfolds. It is the outline for the topic today. I'm going to try to start at the top of it and move down through every decision path. I do not expect you to memorize it. It would be helpful to you if you would learn to use it as a tool. If you would look at it and see its characteristics and therefore see the predictable nature of accounting, it would be good for you. Let's see how it unfolds. The first decision is, are we talking about an accrual or a deferral? And the definition, the simple short definition is there. Accruals lead up to the exchange of cash. Deferrals come after the exchange of cash. We'll come back and look at the decision tree as we go through it. I'd like to talk about identifying them. I'd like to talk about some perhaps more dictionary sounding definitions. I've given you my paraphrase. Let's see how it might have read in the book. An accrual is an expense that has not been paid. Or an accrual is a revenue that has not been received. Now notice from the definition that accruals can be expenses or revenue. And we've encountered both. An accrual is an expense that has not been paid, like salaries. An accrual is a revenue that has not been received. We did work. We haven't billed the customer yet. We make an adjusting entry, debiting accounts receivable, crediting service revenue. A whole bunch of people should have gone, I remember how to do that. And even I'm cueing you right this minute and you're not following my lead. We've recorded both these kinds of things already. I'm just putting words to the actions that we've already taken. Accruals can be both expense and revenue. And I've been giving examples all of today. You should be able to write some down on your own right this minute. Salaries in the last time we were together in lecture. Interest expense that's accruing every day in your homework assignments. Taxes accrue every day. So, these are examples of accrued expenses. When we perform services for customers and they don't pay us, that's an example of accrued revenue. There are others. I'm trying to give some that you've seen and heard before to try to get you to relate to the things that I'm explaining to you today. Let's talk about a definition for deferrals. The word itself, defer, postpone, put off, delay. A deferral is a delay in the recognition of an expense already paid or of revenue already received. It's the delay in an expense already paid. So when we were tutors the first day of class and went to Office Depot and bought supplies and came back, many people would have thought that was an expense. But we still had that asset when we put them on the shelf in the dorm room and waited to call them an expense later. That was the delay in the recognition of an expense already paid. When we pay the insurance in advance for a year and have it expire every day, but make no entry for it, and make an entry to record insurance expired just before we prepare the financial statements, we're calling the asset portion of that delaying that expense to the future when we would receive the benefit. On the revenue side, the book's been teasing you with unearned revenue several times now. I've been trying to delay it until this week to talk about it. I can delay it no longer. Most of the revenue that we earn, we do the work for and they pay us right then, or we do the work for and they promise they'll pay us later. Debit accounts receivable, credit, service revenue. Some industries collect revenue in advance. When they collect the money up front and haven't done the work, that's unearned revenue. Every time they do the work, they're entitled to call that revenue. It's the delay of revenue already received. Deferrals. Examples of deferrals I just gave. supplies, insurance. When we're a tenant and pay the rent, we pay the rent for a month. We prepay that rent for the right to use that building for that coming month. Technically, that's an asset when we pay it. We call it an expense for our own convenience. Revenue examples are newspapers or magazine companies that collect subscriptions in advance. Life insurance companies collect premiums in advance. House and automobile insurance companies collect premiums in advance. Landlords collect revenue in advance. They're all examples of revenue that we've collected that's really a liability until we give them the service or the good for which they've paid in advance. These are good examples. Now notice in the definition that deferrals can be both expenses and revenue. And accruals could be both expenses and revenue. Glance back with me at the decision tree. We defined accruals and deferrals by when cash changed hands, and now as that decision tree unfolds, we see that accruals can be both expense and revenue, and deferrals can be both expense and revenue, and those are the paths that I need to take you down as fast as possible today. You need to be clinging to what you already know and allowing me to stretch you just a bit to show you some things that we'd like for you to know in addition to what you've already mastered. Here's an example for us to consider. Salaries increase as employees work each day. But for our convenience, salaries are typically recorded when we pay them. Since cash is paid after the event, salaries are a really good example of accruals. You've seen this one before, the last time we were together in this room. When payday and the end of the year don't fall on the same day, it's necessary for us to reflect the benefit we've received and the liability we've incurred by debiting salaries expense and crediting salaries payable for the amount we incurred. Every person in the room had the potential to know that before today. I'm not sure that's why we came today. I think the reason we came today was to realize that if this is true for this one particular accrual, we could broaden our perspective and realize this same thing would be true for all accruals. Let's talk about it. Let's talk about accrued expenses on the decision tree. Glance back there with me. If we're talking about accruals, if we're talking about accrued expenses, the adjusting journal entry that we make at the end of the year will debit an expense and credit a liability for the amount we've incurred. Did it work for salaries? Debit salaries expense and credit salaries payable. Sure did. What if it's interest? How about debit interest expense and credit interest payable? That works. How about taxes? Debit taxes expense and credit taxes payable. What I've tried to do is give you a generic description on the decision tree that would fit every possibility like this where there was an accrued expense that needed to be recorded. Accrued expenses. Let's talk about an example of accrued revenue. A scenario. A CPA firm is auditing a client's records. The engagement begins in mid-November. I'm trying to draw a little timeline at the top of this so you can see it. And lasts through the end of February. Every day as work is being performed, revenue is earned. Since cash won't be collected until the completion of the engagement after the event, this is a good example of accrued revenue. If we do nothing and prepare a financial statement as of December 31st, we won't be matching revenue with the right year. Because we're preparing financial statements dated December 31st, we're obligated to record that portion of revenue that we've earned and reflect it on the income statement we're about to prepare. We need to make an adjusting entry. And you've made an adjusting entry similar to this one. debit accounts receivable and credit service revenue for the portion of the revenue that we've earned from the beginning of the engagement until the day the financial statement is being prepared. Accrued revenue. The only thing that's new about that is the term. Maybe you didn't know that was an accrual until today. You were supposed to know how to make that journal entry before today. And I'm not sure that's why we came to class today. We already knew this. I think the reason we came to class today was to broaden our mind and realize that if this is true for one item of accrued revenue, it must be true of others. Glance at the decision tree with me. If we're talking about accrued revenue and would like to know the adjusting entry that we should make at the end of the year, the decision tree describes it broadly and says debit an asset, credit a revenue account for the amount you've earned. So if we had money in a savings account and we're earning interest on it, it might be debit interest receivable, credit interest revenue. We could use this pattern and apply it to other circumstances that would have similar characteristics. They would just bear different names of accounts to accomplish the same thing. Accrued revenue. Now, one of the new things we need to learn is in the appendix to the chapters. I forget whether it's 3 or 4. It's something called reversing entries. And I'd like to do just a who, what, where, when, why kind of thing with you in the next minute or two to introduce reversing entries to you, and hope that through all the events this week that you would know reversing entries better at the end of the week than you did in this introduction. Reversing entries are exactly the opposite of adjusting entries. Allow me to illustrate, please. Could you look at me and the way I'm gesturing and imagine that it's a journal entry? Does it look like a journal entry to you? Say yes or no.
No.
I failed. I was thinking that if I wrote the debit first against the left margin and I indented just a bit for the credit, that you might see this as a journal entry. Would you glance again and respond again? Does this look like a journal entry, yes or no?
Yes.
I'm going to declare this is an adjusting journal entry. And I'm about to reverse it. Would you watch? So what can we conclude? Whatever was debited is credited. And whatever was credited was debited for the same amount as it was originally. Now, I wonder why they call them reversing entries. You with me or not? Yes. Reversing entries are exactly the opposite of adjusting entries. The question is, which ones need to be reversed? Well, I've got a short-term rule and a long-term rule. A short-term rule that works sometimes and a long-term rule that works all the time. Let me introduce them to you separately. The quick first rule that I'd like you to know is all accruals need to be reversed. Say it. All accruals need to be reversed. We'll talk more about it in a little while. All accruals need to be reversed. Just take my word for it for the time being. Well, when do they need to be reversed? In previous class periods, we talked about 10 steps of the accounting cycle. Business transactions create source documents, and we prepare a worksheet and all these other things. And the very last event was to prepare a post-closing trial balance. Our last official act of the year ending is to make sure we're in balance, prepare a post-closing trial balance. You were supposed to be familiar with that when you walked in the room. So the next morning, the next business day, when you come to work, unlock the front door and go straight to the office and make reversing entries. Technically, reversing entries should be, I guess it's item 1/2 before item 1. It's the first activity in the new year. You make reversing entries on the first day of the new year. I was really preaching this one day in class, and a student in class raised his hand and said, "Before you make the coffee?" And I said, "Okay, if you want to put it like that, we'll say, yeah, before you make the coffee, let's make reversing entries." And it kind of stuck. It's the first official act in the new year, reversing entries. Why do we make them? It is one of the hardest things for us to get across, and that may take all week to do. But we're going to start on it today. I think when you make reversing entries, things go better in the coming year. Things are going to work out easier. Things are going to be more normal. It's going to be the routine way you always handle transactions in the new year. We're going to talk about all of these things in the next few minutes as I attempt to demonstrate them to you. But for the time being, I'd like you to know what they are, exactly the opposite of adjusting entries, which ones need to be reversed, all accruals. When do we do it? On the first day of the new year. And why do we do it? Because we're going to be better off. We're going to learn a lot more about this all through the day and all through the week. For now, all accruals need to be reversed. We're going to learn a new rule that applies to these circumstances as well. The decision tree mentions reversing entries. When you go down the accrual path, whether you're talking about expenses or revenue, it reaches the conclusion all accruals need to be reversed. It's a good tool for you to use this week and on other occasions to kind of sort out what you need to know. Let's shift gears. We've talked about accruals. Let's talk some about deferrals. We've defined them. We've seen them on the timeline about when cash changes hands. Let's see if we can't use some examples to kind of demonstrate them to you. We've talked about examples. You've written down this in other parts of this handout. Deferrals are things like buying supplies in advance, paying for insurance premiums in advance. If you pay rent, you use somebody else's building, you're paying the rent at the beginning of the month to use that building for that month. That's rent expense. These are all examples of deferred expenses. You know half of what I'm about to present. I'd like to stretch you into the other half. What you didn't know before you came to class today was there were two acceptable ways to account for deferred expenses. We've demonstrated them both to you. You are aware of both, but you didn't realize you were aware of both. I would like to raise your awareness in the next few minutes. There are two acceptable ways to account for deferred expenses. They are called the asset method, which has been presented in our book the most and is emphasized the most in the chapter and in your homework, and the expense method, which is presented in an appendix in the book and we will be emphasizing in class. You have one homework problem late in the week that uses the expense method. What I need to give you the freedom to do is realize that both are acceptable, that really neither is preferred, that you can do both in the same company to different circumstances. We can accomplish exactly the same thing with both of these. Let's do it. Let's talk about deferred expenses. First of all, we can identify them. Students ask me when they're doing a homework problem, how do I know whether they're doing the asset method or the expense method? Or in real life, how would you know whether we're using the asset method or the expense method? Well, there's a couple of ways. How did you write it down the first time? Where was the very first transaction recorded? If in an asset account, it's asset method. If in an expense account, it's expense method. It's that simple. So let's test that one for a second. The first day of class, when we were a tutor and went to Office Depot, we debited supplies, an asset. That was asset method. But in every homework problem, when we've paid the rent for a month, we've debited rent expense. Yes? That was expense method. So you didn't know it, but we were showing you both. We just didn't put names on them. Where was the initial transaction recorded? Or you say, okay, I wasn't there when the initial transaction was recorded. Well, I just arrived. Well, look at the trial balance. If prepaid insurance has a balance and there's nothing in insurance expense, it's asset method. If rent expense has something in it and prepaid rent doesn't, It's expense method. Where is the balance of the account now before you adjust it? That's the method they're following. We need to know which method we're following in order to make the right adjusting entry. Now, I kind of did this already, but I want your feedback. I want you to realize that you've been doing both before today. Where have you been recording insurance? When you read a transaction and a homework problem that says paid insurance premiums for a year, what did you debit? Everybody said prepaid. You debited prepaid insurance, which is asset method or expense method. Say something. That's asset method. When you bought supplies, you went to Office Depot and came back to the office and debited supplies or supplies expense. What'd you debit? Supplies. Now, some of you are having a flashback to a conversation that we had where you were kind of riding the fence. You did both. Some discussion groups got a little extra flavor. Well, Demetrius, was it you and I that had the conversation one time about debit supplies or debit supplies expense? You remember that day? And we had a wonderful conversation that day, and I said, I want to tell you about that later. Well, the time's come. We ought to talk about that, don't you think? I think so. So where did you record the rent? You read in a homework problem, paid the rent for the month. What'd you debit? Say it. Speak up. When you paid the rent for a month, what did you debit? Say it. Thank you. You used the expense method and didn't even know it. Now stop right there just a second. That's not why we came to class today. The reason I brought it up right this minute, the way I need to stretch you right this minute, is to tell you that either of these is acceptable. We could have used the expense method for insurance. We could have used the expense method for supplies. We could have used the asset method for rent, and that's what we've got to learn in the next few minutes and the rest of the week is about these other alternatives. I need to give you the freedom to do it the other way. Let's do some review and let's stretch to new. So what if we had a beginning balance in supplies of $100? What if we went to Office Depot, let's make up a number, 19 times? Is that okay with y'all? Yeah? Did we just go to Office Depot once and buy supplies for the whole year, yes or no? No. We went to Office Depot 19 times. And every time we came back to the office and we debited supplies and we credited cash. When we get to the end of the year, this balance, $500 in that account, we would call mixed, confused. Some asset and some expense all stirred up together in that account. Doing nothing overstates that asset and overstates the expense. Understates the expense. We need to do something. We need to know more information. We need to go count the supplies that are in the supplies closet. If we determine that there are $50 of supplies on hand, we need to make an adjusting entry. Now, I'm confident that many of you could. I should be patient enough to wait until one of you does. In the interest of time, I'm going to do it, knowing that's not the most effective way to get this message across. You need to be thinking right now while I'm stalling and decide on that adjusting entry on your own. You are capable of making that adjusting entry right this minute. This is review. We've already been here. If we have ending inventory of $50, we're being told there should be $50 in the asset account. That's what we want to defer to the future. We need to get $50 in the asset account by making an adjusting entry for the difference. The $500 that's in there minus the $50 that we want to leave in there means that $450 of those supplies have been used. The adjusting entry we'll make will debit supplies expense and credit supplies for $450. If you're with me right this minute, say yes.
Yes.
Good. Let's post. Let's see what we accomplished. When we post the $450 to supplies expense, we're matching the right amount of expense with the right year. When we post the $450 credit to supplies, we've reduced it to the balance that we have. We've left $50 in the account to defer to the future. Both financial statements are better because of this adjusting entry that we made. But what if? What if? The decision tree conclusion led us to that. We're talking about deferrals. Using deferred expenses, we know that there are two ways to account for these. We can use the asset method or the expense method. On the decision tree that you have in front of you, it says debit an expense and credit an asset for the used amount. That's exactly what we did for supplies. The same thing would be true with prepaid insurance and others if we were following the asset method. There ought to be some comfort in that one. That's what we've done. I'd like to stretch you to a new circumstance. It's possible to have followed the expense method and done it consistently and accomplish exactly the same thing. Go there with me. If we got to the end of the year and saw that the beginning balance was in supplies expense, and each of the 19 times we went to Office Depot, we came back to the office and debited supplies expense, we could have. Lots of companies do. We would have found $500 in that account mixed. Doing nothing would overstate that expense on the income statement, understate the asset supplies on the balance sheet, and mess up both financial statements. Don't you think we ought to do something? We should. We need, first of all, to go out and count the supplies. We've counted the supplies and determined there are $50 worth of supplies on hand. I would like somebody in here to make that adjusting entry for me. In the interest of time, I'm going to tell you. But you would learn more if you would try and get it right or miss it and learn from it. We want to accomplish the same thing. To defer $50 of unused supplies to the future. We need to debit supplies with $50. We need to credit supplies expense with $50. Doing so will improve both financial statements. One balance sheet benefit, one income statement benefit, both are better. Let's post and see. Posting $50 as a debit to supplies defers that to the future. Posting $50 as a credit to supplies expense reduces that to the $450 expense that we've really used. Both accounts are better, both financial statements are better as a result of this adjusting entry. If that's true of this one circumstance, deferred expenses using the expense method, it must be true of all of them. Let's see what the decision tree has to say about this. We're talking about deferrals. We're talking about deferred expenses. There are two ways that we can account for these deferred expenses. When we account for them as expenses, we debit an asset and credit an expense for the unused portion this time. Let's compare what we've accomplished. Will you help me do the math? You can do it in your head. What is the balance of this supplies account? Tell me. What's the balance of this supplies account? What's the balance of this supplies expense account? What's the balance of this supplies expense account? What can we conclude? Both methods accomplish exactly the same results. Does it matter which method we use, asset method or expense method? Yes or no? It does not. It does not. What matters is that we pick a method and we consistently follow that method. The key word in administering methods like this, where we have choices, we need to make a choice and then consistently follow that choice. I think consistency has two key parts. The consistency has one part all during that year. Remember me making up the silly example that we went to Office Depot 19 times? Well, let's pretend there are 19 arrows there representing individual trips to Office Depot to buy office supplies. January through December. That's what those letters stand for. All year long, I bought supplies. I either debited supplies, asset method, or debited supplies expense, income expense method. I didn't flam between them. I didn't do it this way sometimes and this way sometimes. I consistently followed that method all during that year. Consistency has two parts. All during that year and from one year to the next. Once you pick a method, you should stick with it. Does that mean you can never change? No. But don't change and then change again and then change again and then change again. The only way we can compare results on financial statements from year to year is when we have consistently followed accounting principles and accounting choices. We should follow one method all year long, and we should follow it from one year to the next consistently. Now, we brought up the topic of reversing entries a little while ago. The who, what, where, when, why. The what are they? Which ones need to be reversed? When do they need to be reversed and why? Let's talk about that and see if we can't stretch a little bit. The rule we learned a few minutes ago was all accruals need to be reversed. We're now going to label that the old rule. It works sometimes. Do you like rules that work sometimes? The reason we like rules, if we like rules, is that they work all the time, right? Let me give you a rule that works all the time for accruals and deferrals. The trouble with the old rule, all accruals need to be reversed, is the example we've used in the last few minutes is they're deferrals, and that old rule just won't work. We can come up with a new rule that works all the time. It's a little wordy. I'm going to say it two ways as fast as I can and ask you to try to participate in understanding it this week so that you won't have to memorize it. Understand what I'm trying to convey. One way to say the rule would be if an adjusting entry creates the balance in a balance sheet account, if an adjusting entry is the first entry in that balance sheet account, if an adjusting entry creates the balance in a balance sheet account, a reversing entry would be to our advantage. Now might be a good time for me to say, reversing entries are not required. Reversing entries are optional. But reversing entries are highly recommended. Things go better when you make reversing entries. If on the first day of the new year, before you make the coffee, you reverse everything that needs to be reversed, things are going to go better. So, that's that last phrase. Would be advantageous, would be to our advantage. If an adjusting entry creates the balance in a balance sheet account, we should reverse it. The other way to say this is kind of the same thing, but just a little bit different. Some people might be able to relate to this better. If the direction of a deferral adjusting entry is balance sheet to income statement, it does not need to be reversed. It's fine. But if the direction of an adjusting entry is income statement to balance sheet, it does need to be reversed. Now, that's when we get back to exactly the same lingo as the first way I tried to say this. If an adjusting entry creates the balance in a balance sheet account, it needs to be reversed. Deferrals start with the exchange of cash. Because we exchange cash, something had to be written down. There's something on the books happening all the time that we're ignoring until we get up to the adjusting entry step. If the adjusting entry moves that item from balance sheet to income statement, you don't have to reverse it. But if you move that from income statement to balance sheet, it does need to be reversed. If the direction of an adjusting entry is income statement to balance sheet, it should be reversed. I thought I'd already uncovered that. Sorry. Let's see if we can't find an opportunity to apply it. Which one of these needs to be reversed? You need to help me. It's all about applying that important part of the rule, creating the balance in a balance sheet account. We've got to know which of these accounts is balance sheet. Is supplies or supplies expense the account that goes on the balance sheet? Say something.
Supplies.
Now, there's a beginning balance, and then we went 19 more times and debited this account for $400 total. Is this the first entry in that account? Yes or no? Speak up.
No.
No, there were 20 other entries. Yes?
Yes.
If an adjusting entry creates the balance in a balance sheet account, did this create the balance in a balance sheet account? Say yes or no. Say yes or no. There's 20 entries before this one. This did not create an entry in that account. Does this need to be reversed? Say yes or no. This one does not. That's asset method. Here's expense method. This is what we did today. There was a beginning balance. We debited it 19 more times. We counted. We found the ending inventory was $50. We credited this. We debited this. We closed it in the second step of closing entries. It's the first day of the new year. We came to the office. We haven't made the coffee. And we look and see that there's a balance in supplies. Is this the first entry in that account? Yes or no?
No.
I don't see any other entries in this account. Is this the first entry in that account? Yes or no? An adjusting entry created the balance in a balance sheet account. Do you see the difference I'm trying to get you to see between these? This one, we've been using it all the time. This one, we only used it when we made an adjusting entry. Yes? Did we create the balance in a balance sheet account? Does it need to be reversed? It does. Following the expense method, we need to reverse it. We need to reverse this because there is no other normal transaction that will return this balance to that account where it belongs unless we do this. The reversing entry will take that balance and will do the opposite. Credit what was debited and debit what was credited. And we'll transfer that balance to supplies expense. Do you remember that we were following the expense method? And now the beginning balance is in the expense account, right where it belongs. And we can proceed. The decision tree says this. The decision tree says that the asset method does not need to be reversed, but the expense method needs to be reversed. In your note-taking guide, in the middle of page 5, there's an area that has a whole bunch of question marks on it. And it is an example that you could follow and do on your own. There's a solution on another module on the class website. It spills on to the top of the next page. You could practice that on your own, go to the website, answer it yourself, and check your work against the answers that pop up on the website and get feedback so that you know whether you're getting it right or not. I would really encourage you to do that. I'm about the middle of page 6 in the handout, and we're talking about deferrals and accruals still. We're talking about deferred revenue this time. So deferred revenue, we've got some possibilities here. We've been doing it one way. The textbook has mentioned it to us a couple of times, but there's 2 ways that we can handle this. Examples of deferred revenue would be landlords that collect rent in advance, magazine companies that collect subscriptions in advance, life insurance companies, auto insurance companies, lawyers collect fees in advance. They call them retainers. Let's make up an example and see if we can't apply it to this situation. Let's assume that we're the attorneys for Jones Fraud and Swindle, and their year ends December the 31st. They received $1,200 in cash on September 1st for a year's service in advance. So this timeline is trying to get us to help see the facts of the situation. Here's the note, September 1st receipt, and the problem with that is that it's revenue that we've received in advance, and it's going to take us 12 months to earn it. Now, if we earn all of that in this year, then that's not a problem. But if we earn some of it this year and some of it next year, then we've got a problem in allocating that amount, matching that amount of revenue with those 2 years. There are 2 methods for accounting for deferred revenue. They are called the liability method and the revenue method. And they are attempts to answer the question, when you debit cash because you collected it in cash, what are you going to credit? Now, if you think about it, both liabilities and revenue have credit balances. So we could credit either one of those and have this journal entry work out correctly. When you debit cash, what are you going to credit? You've got 2 choices. Credit the liability or credit a revenue account Let's go down each of those paths. Let's see how that works out. One of the things that students ask me is, how do you know which method they're using? Well, one of those is, where did you write it down originally? When you debited cash, what did you credit? If you credited a liability, it's liability method. If you credit revenue, it's the revenue method. And you say, well, I wasn't there. How do you know if you weren't there when the initial transaction was recorded? Well, look at the trial balance and see where the balance of that account is before adjustment. If the balance is in a liability account, it's liability method. If the balance is in a revenue account, it's revenue method. So let's consider this example for the lawyers and say this first time that we're following the revenue method. When we collected cash, we thought that that was revenue, and we credited fees earned for the $1,200 on September 1st. Now we've done some counting and some calculating, and it seems that 4 months have been earned by the end of the year, and 8 months won't be earned until next time period. So that's the allocation we're attempting to make. The 4 months earned and the 8 months unearned. Consider for a moment doing nothing. If we don't do anything, we're going to overstate revenue, we're going to understate liabilities, and we're going to mess up both financial statements. We need to do something. By recording the adjusting entry, we can make both financial statements better. We need to debit fees earned and credit unearned fees with the $800 that is unearned that is to be deferred to the future. Debit fees earned and credit unearned fees will improve both accounts and both financial statements. That $800 is the unearned portion. We are deferring it to the future, thus the name. This is a deferral. We are postponing the recognition of this revenue until next time when it will be earned. When you post that journal entry to those two accounts, you see that the unearned amount gets transferred over to the unearned account, and both accounts are better. Now, one of the reasons we're doing this is to reach a conclusion. If it's true in this one case, it must be true in others like it. So that's how the decision tree comes about. If in this case we debited fees earned and credited unearned fees, what would we do with other similar situations? If you follow the deferral path and follow it through the journal entry that you're attempting to make for deferred revenue under the revenue method, you'll see that the decision tree says this very thing. Debit revenue, credit liability for the unearned amount. Debit revenue, credit liability for the unearned amount is the generic way for saying what we said in the specific example that we were working. Let's pretend we didn't do that one. Let's begin again with this fact circumstance. The attorneys collected $1,200 in cash on September 1st. They debited cash. They were looking for something to credit, and they decided to credit unearned fees. They credited unearned fees for $1,200. This is the liability method. This is the way we've done it most in the book, when the book has slipped this in previous homework problems. So let's consider doing nothing. If we do nothing, we overstate liabilities, understate revenue, and mess up both financial statements. We need to do something. So let's make a journal entry to record the earned portion. The $400, 4 months worth, has been earned. Let's debit unearned fees and credit fees earned with the $400. Let's transfer the earned portion from the unearned account where it's recorded to the earned account, fees earned, and make both better. Debit unearned fees, credit fees earned with $400. When we post, that will leave $800 in unearned fees. That will put $400 in fees earned and match it with the right year, match it with the appropriate amount in this time period. If we find that that's true in this circumstance, we can generalize and say that it would be true in others as well. Debit unearned fees, credit fees earned in this specific entry translates to the decision tree conclusion. If you're recording deferred revenue, the adjusting journal entry that you make at the end of the year depends on the method you're using. Choices are revenue method and liability method. If you take the path liability method as we did this time, you'll debit a liability and credit revenue for the earned amount. Let's talk about these two methods and compare the results. Help me get the account balances of these accounts, please. Can you determine under the liability method the balance of unearned fees right this minute? 1,200 credit minus 400 debit is 800 credit. Under the revenue method, unearned fees is also 800 credit. They accomplish the same thing. Help me with the account balances for fees earned. Under the liability method, fees earned's balance is 400 credit. Under the revenue method, fees earned has a balance 1,200 credit minus 800 debit of 400 credit. Both methods accomplish exactly the same results. Doesn't matter which method we use. We need to pick a method and consistently follow that method all during this year and from one year to the next. But either method will help us accomplish the right thing if we know what we're doing. It's balance sheet presentation, income statement presentation that's so important. We want unearned on the balance sheet as a liability. We want earned as revenue on the income statement. How we get there matters not. Could we consider whether or not these need to be reversed? Let's consider the liability method. Under the liability method, if we apply the rules we've talked about, all accruals need to be reversed. Doesn't help us because this is deferred revenue we're dealing with. The second rule, if an adjusting entry creates the balance in a balance sheet account, it needs to be reversed, always works. So let's consider the liability method and where we started out. We debited cash, credited unearned fees, the liability account. The adjusting entry we made transferred the earned portion from the liability account to the revenue account. We didn't create the balance in a balance sheet account. Does this need to be reversed? No. Now let's reconsider the revenue method. Again, we've got the two accounts, unearned fees and fees earned. If we're following the revenue method, when we collected cash, debited cash, and we're looking for something to credit, had these two accounts to choose from, we chose revenue. The September 1st entry of $1,200 was the first entry in fees earned. Then we took the unearned portion out and moved it to unearned fees. That was the first entry in the balance sheet account. The adjusting entry created the balance in a balance sheet account. That method does need to be reversed. Yes, under the revenue method, we will make a reversing entry. Notice that the decision tree reinforces our conclusion. If you look on the decision tree, you see that revenue method is labeled needs to be reversed. Liability method does not need to be reversed. When we make the reversing entry under the revenue method, we simply find the adjusting entry and do the opposite. Whatever was debited is credited. Whatever was credited is debited. Debit unearned fees, $800. Credit fees earned, $800. In essence, we're moving the balance of unearned fees back to the fees earned account where it belongs. We've chosen the revenue method. We should follow the revenue method the following year. The revenue is in the revenue account, right where it belongs. No further entry necessary. It's right where we want it to be for the following year. There's another set of questions that you could work. It relates to unearned tuition. It's very much like we did, but it would be great reinforcement for you. You've been provided in a handout a place to take notes and follow along with this. And on the class website, there is a PowerPoint presentation that is considered to stand, it was intended to stand alone. More words on the screen, no audio, no video, to let you work through it at your own pace. I would highly encourage you to find that solution on the website and work through that. Take it like a quiz. Try to answer the questions and then click, move to the next slide and see the answer pop up on the screen and reinforce your understanding and confidence. Thumb through the lecture handout. Did you notice some areas that we skipped that had big questions? Those are practice problems for you that are on the class website. And if you would like to go to that out of class lesson. It's just a PowerPoint thing that doesn't talk. It's got more words on the screen than usual. It would be good practice for you to go through those and practice them and see the solutions on the computer so that you could think and decide and take notes and benefit. I hope you have a great day.